First of all, good morning. I want to first thank the hosts here. It is my first time here, even though I've been in Stanford many, many times. I've never been to the JCC here. I want to thank Benny Moran, and most importantly, Izar Shai, who's a personal friend, and that is, I think this is the Restart Israel beyond its the matching and the shidduch to investors, the actual fact that many of these startups do something sort of on behalf and the name of some of the fallen ones is very, very important, touching to me, and that is the reason I'm doing this the second time around and coming and trying to support the Restart Israel program, which is an excellent program given what had happened the horrible day of the 7th of October. What I want to do today is talk a little bit about the Israeli economy. Israeli bonds were mentioned, so I'll try to explain why are we still such a solid investment. I won't be shy, I'll tell you also some of the challenges Israel is facing. So the way my presentation will go is a little bit, how did we enter the 7th of October and what had transpired since then, all right? So let's get going. I don't know if maybe it's this one. So just in one shot, this is how Israel entered the 7th of October. I'm just coming back from Wyoming, from the Jackson Hole meetings, and we were the poster child prior to the 7th of October. You could see we grew, we contracted one of the smallest contraction in COVID, just about 2%, and then we grew over 9% in 21, over 6% in 22, and we're on the way to grow at about 3.5% to 4% in 2023. You could see that green line at the top. Very tight labor market on the top right. And very, very important, since we're talking about sovereign bonds, Israeli debt. Israel has shown fiscal responsibility. We've taken Israel's debt from about 100% of GDP to about 60 prior to COVID. We used that fiscal space during COVID. We went up to 71, and 2 years later, we're back down to 60, all right? And inflation was coming down slowly to just about below 3%, estimated to be in Q1 24. That was the picture in September 2023. And as I said, when I was talking to Jay Powell or Christine Lagarde, we were the poster child, okay? High growth, inflation coming down very, very slowly. And then 7th of October happened. I'll skip these slides. So this is a map of Israel's economy over different security situations. In red, you see different wars. And you could see that Israel's fundamentally is a dynamic, is an economy that has the foundation for rebounds. After each one of those red events, we tend to grow pretty well. But what you could see, so in gray there, you could see that's COVID. But then you could see the sword of iron war. You could see it's just a different order of magnitude in terms of size. The red, minus 21% in the first quarter after the war had started. But then you see plus about 17% in Q1 24. So that trampoline that's underneath the Holy Land, so to speak, okay, that dynamism is there. We are, it's bounced back. But as you could see, the war has persisted, as everyone understands, and that does take an economic toll. And you could see the quarters afterwards, some of them had shown better growth and some of them have less. And that last red one, that minus 3.5%, that was the campaign, the rising lion vis-a-vis Iran, okay? And that has influenced growth as well. So first thing first, just the resiliency of the Israeli economy and its people. On the left-hand side, you could see these are credit cards. So you could see the big drop, about 30% on the onslaught of the 7th of October, and immediately we were very surprised. Within a month, maybe 2 months, we saw people back at movie theaters, at restaurants, okay? That demand came back up, and you could see we're back on that dash line, which is kind of the trend. And then that big dip down, that's the Rising Lion campaign that we just saw. And look at the big rebound right away and even above trend. Usually when the line is a little bit below trend on a regular time, the Monetary Policy Committee asks if my wife is in the US. But other than that, we are doing fine. In the middle, you could see the unemployment. That big spike there, you have to understand, it's very hard for us to do forecasts. One of the biggest issues regarding the war, and that's also true for the Rising Line, is whether the education system is open or closed. What you see there in the dark gray, that's the regular unemployment. The little shady gray is the way we did, it's called chalat for those who know Hebrew. That's basically government paying furloughs. Companies are putting people in temporary unemployment. The government paying furloughs for that. And then the big blue, dark blue that you could see, that's people in reserve. And then that dotted blue at the top, that just while there were missiles in October, people just stayed at home with their kids. And you could see that same spike is in Rising Line on the very right-hand side. But since then, in general, you see the dark blue, which is the reserves, coming down, going a little bit up in the summer of 2024 before the campaign in Lebanon, coming back down, and then a little bit up since then. Where does that put the Israeli economy with this roller coaster? So you could see we took a big dive relative to where we were supposed to be. We're at about 5% away from where we should have been. But I think the right metric to look at it is that we've endured a shock that is 30 times 9/11. And when you look at it at that perspective and you look at how the economy is still functioning, that is, to me, given the situation, is actually a very much of a show of resilience and the dynamics of the Israeli economy. It will take effort for us to do the catch-up back to the trend. So we do have this gap that has evolved since the war. But overall, and given the shock that has happened, I think many, many people and even other economists are asking, what's the catch? You know, a huge shock, an economy that is going on with a war for 2 years, and yet it is functioning overall. I'll skip this slide for the sake of time. The point that I want to make is the economy, since the beginning of the war, is facing two things that we macroeconomists are looking at. On the one hand, there's demand, and that has to do with sentiment and other things. And on the other hand, the biggest issue are two things. Palestinians are not allowed to work in Israel right now, so we're missing workers, and obviously many, many people are in reserves. That's what I'm calling supply constraint. That balance between the demand and its sentiment and the supply constraint are the key to how inflation and the economy is evolving right now. So what you see here are salaries. So the main point I want to make, the job market in Israel is what economists call tight. On the right-hand side, you see that's the ratio of vacancies, new jobs relative to unemployed. And on the left-hand side, you see different notions of salaries. Basically, if you look at the business sector, you could see the salaries are rising by over 5% on a per annum basis. This is not a small number, and so it shows you firms are chasing workers, and it's actually happening in multiple areas. It's happening in high tech, but it's also happening in services. A lot of the soldiers that usually finish their military service, they go to temporarily work in restaurants, etc. those people are missing from the labor force. A little bit of a picture of how many foreign workers are missing. You see, we used to have about 270,000 foreign workers. That dropped. It's mostly Palestinians. Some have come back, but we're still missing about 10-15% of where we used to be. In the middle, you could see the spikes in reserves, okay? And that's relative to about 7,000 that we used to have on average prior to the war. And on the right-hand side, you could see vacancies. So what is very dominating is services and construction. Construction is where a lot of the Palestinian workers used to be. So the blue there and the red are very dominant, that there's missing workers there. But that's also true in industry and other areas that, you know, there's missing workers. And that is part of the reason, that graph that I showed you, that we are not able to reach back to where GDP, or the general output of the economy, is not reaching where it could have. It's simply because we're missing part of these workers. And so the idea is, once that gets released, we will be able to climb back. What about other constraints? You could say, what other is holding up the economy from going as fast as it could? So on the right-hand side, you have survey of companies that report, you know, constraints on intermediate goods or on products that they need. So you can think of the Turkey providing cement and things like that. But generally, it's there, but it's not as, it's nowhere near the constraint of the workers. And you could say, is credit being provided in the economy? You could see these are surveys of CFOs who are being asked whether they have credit limitations, and basically they're way below even where we were prior to the war, and credit is growing exponentially in Israel. So to sum it up, we're missing workers, very little constraints on intermediate inputs, and credit is not an issue. And so the real problem of the economy right now is on the labor side. What has been another sign of Israel's strength in spite of the war is the tax revenues. You could see how they're even above trend, and of course we'll come back to talk about the cost of the war and how we finance it. So this is a good sign in terms of the economy. Housing, everybody knows housing is a big issue in Israel. So two things. So this kind of tells you what happened to employment in the housing sector. Again, has to do with the Palestinians. There's a little bit of entry into that. In the middle, you could see building starts and building completions. So that big drop that you see there in the red and blue, that's when the war started. Basically, house completion and house starts dropped. But since then, we've seen it coming back. Now, here is a good lesson about basic economics. It's the right-hand side. This is prices of housing. So after we raise interest rate, you could see in the dark line there, house prices have come down. But then house prices have actually retreated to come back since the first quarter of 2024. Now, what's the reasons? Most Israelis understand there's lack of supply of workers. There's going to be shortages of houses, and therefore house prices, if enough people think that way, they go purchase right away the houses, and it becomes what we call in economics a self-fulfilling prophecy, and prices start to go up. Recently, unfortunately, we've seen, due to several features, which I won't get into, we've seen house prices at the tail end coming down, and we hope to see some more of that. Whoop, I'm sorry. All right, I want to talk about financial markets. You mentioned the Israeli economy. So the dark blue that you see there, and you could see the different events. Basically, the stock market of Israel has underperformed since basically the beginning of 2023. the S&P 500. But since the beepers in Lebanon, you could see the stock market in Israel, the dark blue, has started to do a catch-up to S&P. And basically since the rising lion, you could see that we've overshot the S&P 500. Perhaps most related to the bond issue that you mentioned is Israel's risk premium. And the reason we look at risk premium, we think that is a very important metric on how the Israeli economy is going to be evolving over time. Because the higher is the risk premium, the higher the cost for the economy, and it's some kind of a weight on the Israeli economy. So in blue here, what you see is the Israeli CDS. For those of you who are not in finance, the CDS is the premium you pay to insure an Israeli bond in case it's default. Now, amazingly, you could see the red, which is the US, and the blue, which is Israel. We started off the same place as the US, okay? And then you could see the spike after the war had happened. You could see it gradually going up, okay? All the way up to the beepers. This is different Iran shootings, and then the beepers, it subsided a lot, and then kind of went up a little bit more, and then after the rising lion has dropped very significantly all the way to about 70, 75 basis point, still higher than where we were before, but significant improvement. If you think of this as reflecting some kind of geopolitical situation, if that, what the markets are telling you, we are in a better situation than we were throughout all this period. And this is also reflected in these, on the right-hand side, it's the difference between an Israeli bond and an American bond. And pretty much you see the same pattern. So this is a very, very important signal about the Israeli economy. I want to say something about the shekel. So what you see here in blue is the Israeli shekel. This is the shekels per dollar. And what you see in orange is what the shekel dollar would have been if you used a very simplistic model based on NASDAQ. Now you could say, why NASDAQ? This is why your guys are sitting here. Israel is very highly influenced at both high frequency and low frequency by what's going on here. At low frequency, when the US economy is doing very well and there's a lot of high-tech activity, that shows up in Israel. People are buying Israeli companies, investing, and the shekel strengthened. In addition, Israel is very paternalistic about pensions. So our pension system is very big, and our institutional investment houses invest a lot in the US. When they make losses, when they lose money here on the S&P, they have to post margin, and they immediately buy dollars. And conversely, when they make money, they sell those capital gains and buy shekel, and that creates a high frequency. So the main point is, you see the orange line tracks the blue line very well until the judicial reform started. Then there is a wedge that started between the blue and the orange. We received essentially a depreciation of the shekel that affects inflation. Then you could see the war started and the shekel moved. I remember exactly, Friday, October 6th, the shekel was at 386, 11 p.m. New York time. It went to ultimately to 408. 2 months later, it subsided to about 3.6. And since then, it moved with geopolitical events between 3.6 and 3.8. And then after the rising lion there, you could see at the end, there is a big significant appreciation of the shekel. And that's also reflecting what you just saw in the CDS that I mentioned. So I'll come back to the shekel. Since I'm the governor of the Bank of Israel, I want to tell you a little bit about what we had done on October 7th. So let me first start with the left-hand side, which is what every central bank does, which is raising, it's called monetary policy. But the first thing I have to say, on October 7th, while they're still shooting, I have to decide whether the stock market is open, whether the banking, what's called a business day. We have our own analysis, we did what we did, and we decided it's very important to open things, and we did on the 7th of October. The 8th of October is Sunday. There's no foreign exchange trading, but we knew the shekel was going to take a beating on October 9th, Monday. What we did is we have one of the strengths of Israel, which I skipped that slide. We manage over $200 billion of reserves. I'm, in essence, a very, very big hedge fund or whatever you want to call it. And we, for the first time, prior to trading, we already saw what was going on in Asia. We announced that we are going to sell up to $30 billion and provide up to $15 billion of swap lines. To me, that was, if there's one lesson in economics that we know, you do not want the crisis to become an economic crisis, or if it's a health crisis like COVID, which became an economic crisis, to spill over into a financial crisis. That's when things really start blowing up. So in order to avoid that, we took those steps prior to trading. The idea was to allow markets to function, okay? You saw the shekel went from 386 to 408, but it did it in an orderly fashion. We bought the country time until things improved on the southern border, and then you saw the shekel went from 408 to basically 36. And that was very, very important, because the lesson that we know from Friedman, Bernanke, and others is that you do not want to get into a financial crisis. That's when things amplify into a very dire situation potentially. The middle section is the fact that the Bank of Israel also supervised the banks. About 50% of the central banks do that in the world. We are one of them. So what do you do with a bunch of people who rent out with their pajamas away from Otef Aza, and a whole bunch of people took their military kit bag and ran into the borderline, into the war zone? What do you do with their mortgages? What do you do with their consumer loans? I had all the CEOs of all the banks in my office, October 13th. We had a unified plan in which mortgages, consumer loans, overdraft, and small and medium enterprises, all these loans are deferred. It tells you a little bit of our process back then, deferred for 3 months, no commission, no interest, to be paid a year later. This has been extended since then 3 more times, including the people who were evacuated from the north. This was very, very important because this was targeted relief to the right people. So that's October 13th. October 22nd, we had our first interest rate decision. That's how it was scheduled. We were considering, should we cancel it, should we not? It happened to be one where we give a forecast every other interest rate decision. How do you do a forecast? Well, we did a forecast the best way we can. And it turned out it was very important forecast. We forecasted the economy is going to grow at 2%. The numbers that were running at that time, if you go back to the media, were minus infinity to 0, okay? We came out with 2%, and that came out to be the numbers. Sometimes luck happens. But it was very, very important because it settled the conversation on reasonable amount of numbers. And so the last thing that I have to deal with, which I think no other governor in central bank has to do, that is also be the economic advisor to the government. So what that means is you want to manage monetary policy on the one hand, but on the other hand, you mingle with budgets of the government. And that's a tricky business. All right, so before I go and tell you a little bit about the cost of the war and that challenge for Israel, let me say something, since your guys are about the high-tech sector, and clearly that is the locomotive engine of the Israeli economy. So here's one slide that tells you how important this sector is for Israel. Over 1/3 of taxes, it's now 16 to 17% of employees, over 50% of exports, okay? It's just amazing how big it is and what kind of brand name it has. In terms of funding, Israel's high-tech sector gets funding that is disproportionate to other countries. If you look at the left-hand side, you see this is as percent of GDP. It's much bigger than the US. If I had Europe here as another color, you would barely see it, okay, as percent of GDP. Now you could see 21 and 22 were just abnormal years. That's when fintech and, I mean, those were years where the high-tech funding was huge. I remember I had Ruth Porat in my office. Back then she was the CFO of Google. Now she's the CEO. I just met her in Wyoming, and she was back then. I was saying I was a bit. I was telling, look, every little 2 kids coming in with a PowerPoint presentation are getting funding, frothy funding, and she was telling me, Governor, you are absolutely right, but it's not PowerPoint, it's Google Docs. Since then, NASDAQ dropped, and you could see that also in the middle slide, and we're seeing recovery. The good news, in spite of the war, and this is maybe a very, very important slide for those of you who are investors here. So you could see the dip there at Q4 23 and maybe Q1 24, but since then we've seen gradual increases in funding, and funding is coming back to the Israeli high-tech companies. Many of you have seen the exits, of the amazing exits that we've seen. These are not exits, these are capital funding, capital raised. And so that ecosystem is moving and is showing great resiliency in spite of this war. One thing about the high-tech, the Israeli high-tech, why is it so resilient, and what is different than 2001? 2001, I want to remind you, the dot-com blew, coinciding with the second intifada. That was the biggest drop in Israel's GDP per capita, okay? What is different is that in 2001, the Israeli high-tech ecosystem was mostly dream companies, no product, not diversified. It was mostly in telecom. Look at the pie chart to the left right now. Israel has a footprint in many, many areas. Everybody knows how good we are in cyber, medtech, fintech. We have the CTO from the IEA. Under the orange here, where it just says other, you can imagine there's also a lot of security-related high-tech issues. I don't need to explain to the people here. There's a lot of increase in demand for those things, and Israel has a lot to show for in that area. On the right-hand side, you see most of the companies are not dream companies. They have over 60% of them have some kind of a product on the table. This is not just something up in the air. So the diversification of this area is very, very big. On the northwest top corner, you see agrotech, the whole area that's called deep tech. It did take somewhat of a beating during the war, especially a lot of the agrotech in Israel is in the north. But again, you can imagine Israel has a lot to offer here, and certainly if there is developments in the Middle East, we know, I always say, we can grow a really good-looking tomato out of a rock, and we have a lot of neighbors that need food subsistence and food security. Inflation, it's probably less of an issue for your guys. We're at 3.1% right now. The target in Israel is between 1% and 3%. There are some sticky things like rents in Israel are expensive. There are other things. My basic premise is, so this is things that are non-traded, like rents. These are the more traded things. Basically, going forward, we're seeing inflation is subsiding downward, but it's very, very choppy. So we are very, very data dependent in our approach. Our interest rate currently is at 4.5%. And we will have to see how inflation comes down to see how the economics of supply and demand are coming into an equilibrium. So you understand, the less workers there are, the more supply constraint, and that's an inflation that comes up out of and creates excess demand. It's not demand, it's excess demand, not like euphoria demand like it was after COVID, but because there's not enough workers, it still creates pressure on prices. So we have to see how that process evolves. I won't bore you, but basically we have a way to decompose this. The slides will be available, but basically we have a way to look, and for those of you who remember your very basic course in economics, first course, supply and demand. If we see the supply increase, we know both the quantity and the price will go down. If we see demand increase, we know that the quantity and price will go up. So by looking at these pairs, we can figure out what constraint is actually more binding, and we're seeing a lot of significant supply constraints, and that's what we're looking for. This is the 14 professional forecasters' view. You could see right now we're at 3.1. They're projected to be at 2.8. I wish that will be the case. I hope that will be the case. But we've seen inflation be extremely choppy and a lot of mistakes because it's very hard to predict things in an economy that is facing a war. So if you look at their forecast, they've had many errors over time, but we hope that's the way we're going. So let me just say something about the budget. So first of all, the cost of the war. So the war cost about 250 billion shekels. And this estimate, I'm intentionally giving it, this was what we saw in front of us when we formed the 2025 budget. Since then, we've had Merkavot Gidon, we've had Rising Lion, we've had an extended period of reserves still in Gaza. We've had damages that have to be paid for the missiles that hit, et cetera, et cetera. So this is on the order of 250. There's probably another close to 50 that the government had already signed on to give the military, and there may be another 50 for miscellaneous since then, okay? So this just tells you where we were back then. Now, what is the challenge for Israel? And you mentioned bonds. Israel is facing what I call the trilemma. First, we need money for defense. The economy, the economy needs security, but security obviously also needs a flourishing economy. So that balance act is very important, and you could see on the right-hand side, Israel is on the extreme among the OECD in terms of spending on security and defense expenditure. And obviously, that went up since the war had started. On the other hand, those of you who have driven in Israel, okay, know how bad the infrastructure is. Even though we're investing a lot of money in transportation in the recent years, it's a catch-up of a whole of basically trying to catch up of something that should have been done many, many years ago. So the infrastructure, both in terms of, especially in terms of transportation, is very, very low. And in a second, I'll show you something about education. So what has happened to debt to GDP? We went from 100 to 60, went up to 71, dropped to 60, and now we're at around 68%. Now here you see several scenarios that we've done back around the budget of 2025. Now one of the issues, I told you, I'm also the economic advisor to the government, and I've talked to the Prime Minister both in 2024 and in the budget of 2025. What's important for a country like Israel? Nonetheless, as strong as our economy is, as innovative as we are, we're obviously facing different geopolitical situations than the US. We do not want to be on a debt to GDP profile that is just diverging upward. So what was critical in the 2024 budget was to take actions such that we have an inverted U-shape profile and a credible one. So I remember before the 2024 budget, I told the Prime Minister, okay, first, give the military just what they need under every scenario. And those of you who don't know, we gave them 0.5% of GDP. That was 10 billion shekels for about 8 years going forward. We created, I said, you need to create a committee that looks strategically at what the military needs will be down the future. That was the Nagel Committee, which recommended another 15 billion, 13.5 billion going forward. And I said, if we want to maintain a profile the way it is, and given the assumption of the war, you need to do painful stuff, what we call in soft language fiscal consolidation, which means cuts in the budgets or taxes, and the government did that. So what I do give the government a lot of credit. They did that. They did 1% adjustments during 2024 budget. When we reached the 2025 budget, obviously the war had prolonged longer than we anticipated in 2024. I said, again, if you want to maintain credibility towards the market, that our debt is not rising, unfortunately, we need to do more adjustments. That was the VAT tax that went up in Israel, and other social security benefits went down. Some healthcare taxes went up. That was another 1.5% of GDP, but that maintained a profile that at least it went up, as you could see, but at least is not diverging. And I think these were two critical steps, and I talk to analysts all the time. These were two critical steps by the government at the macro level of the budget in terms of maintaining what you just said. People trust that the Israeli debt is not running away, and therefore Israeli debt is priced accordingly. And so this issue will have to come into bear as we go into the 2026 budget. I do want to give the government a lot of credit for doing these two steps. What should be said is that that's at the macro level of the budget. As an economic advisor, probably there could have been a lot steps inside the micro framework of the budget that could have been a lot more efficient, such as coalition money that could have been avoided, various offices, money that was given to various groups that do not go into the Israeli labor market. And so those are important issues, but at least at the macro level, that's what we've done. And we project right now that we are going to end up around 70% debt to GDP. And again, depending on the projections of the war, we might need to take some more steps fiscally to make sure that this thing settles, and then ultimately the growth of our economy brings it down back. And as long as we do that, that will be very, very important. I'll keep this slide. So the trilemma here, maybe I should just, for those you haven't followed, why is it trilemma? You have high defense expenditures. You need to invest in civilian expenditures, health, infrastructure, education, and at the same time, you want to maintain the debt that it doesn't run away. And managing it is a very, very important balancing act. I want to say something about Israel's challenges for the future. This slide tells you what I already told you. This is comparison to the OECD. You could see we don't have enough infrastructure, like the metro is being built, that's great, but I wish it was already built. We have relatively high poverty rate. And on the right-hand side, what you're seeing is many of your guys are facing the top and the best of the best in the world, certainly around Stanford, Berkeley here, many Israelis, startups, products of the Israeli education system, partly in the past, partly more current, the good universities. However, when you look at international exams, Israel is not doing very well on those exams. You could see on the right-hand side, this is a breakdown by deciles. Even the very top decile, when you compare the very top decile to the very top decile in the OECD, we have to do better. So when I mention investing one has to invest in education if we want to maintain this very ingenious high-tech region that we have. The other challenge we have, this is a demographic picture of Israel. What you're seeing is that the Arab population here on the left in orange is supposed to stay at the low 20%. However, the ultra-Orthodox population is going to grow to be above 20-some%. In the middle, you could see male ultra-Orthodox participate very little in the labor force, and they earn very little. We need them to get core studies, education, and therefore participate in the labor market, so they contribute to the economy as they become a bigger and bigger percentage of the economy. This obviously, in principle, is a separate conceptual issue than being drafted. So this is just going forward, we need them to be in the labor force. Being drafted now, obviously, is also a very important issue. It has we estimated the cost, if the burden continues to be the same burden as it is right now, it's like another 0.5% of GDP if the toll that the defense forces are saying will have to stay with us for the next years continues to be on the shoulders of currently those who serve, that has a cost. Now, where do these two things match or meet each other? The idea is that if they do serve and in the military, there's more likely percentage that they will also end up also working in the labor force. So this is a big challenge for Israel. It's not going to, if you are a high-tech investor, that's not going to affect Israel in the next, this doesn't have an immediate effect, but demographics are like a sand clock. It takes time, but this is something that we need to deal with down the road. I'll skip AI. Israel is very active in AI. We're also trying to produce a center that will give startups ability to use computing, high-powered computing. This is a graph of various areas in Israel that AI is complementary versus AI that might be substitute. So there, you know, just like around the world, AI will affect the labor force. And even here, it will affect different parts of the population differently. And so we need to, this is something that one has to be mindful. But again, Israel has a good footprint in AI, especially in a lot of the application. So I'm going to sum up what are the key takeaways. Maybe the most and the most important takeaway, if you're not familiar with Israel and you've seen the war and you know and you've seen the media and everything, the Israeli economy, I think, in spite of being this 5% away from where it could have been, is showing, I think, great resiliency all throughout this event. And that's the top line. Obviously, we're still facing a lot of uncertainty, clearly locally. There's also a global issue. I don't need to expand on that. And those are affecting the economy. What we've seen is that during 2024, there are a lot of supply constraints that created excess demand, that created inflation. In the first quarter of 2025, we started to see some signs of more demand and some easing of supply constraints. And then rising lion obviously impacted Q2, as you saw. But what we're seeing, as I showed you with the credit cards, and we have many other indicators, both in the labor force. You saw in July, unemployment went back down to prior to the Rising Lion campaign. So we are seeing very fast recovery. After that, the risk premium declined significantly after Rising Lion operation. It still remains higher relative to pre-war, but it's in a much better position. Inflation is a little bit above the upper bound. We expect it to converge into the target in the coming months. Monetary policy will be data dependent and depending on relaxation of uncertainty and inflation environment developments that we see it more clearly coming into the target. And of course, further economic developments and recovery will be influenced by some of the geopolitical developments that are coming along. But again, if I was to take one takeaway, is that the Israeli economy has shown so far a lot of resiliency, and I think it's both basically demonstrate, I think, the people in Israel as well as the underlying dynamism of the Israeli companies. Thank you very much.